Oh man. So why is it
Okay, I
important
know
for,
that was fast.
no, 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 that's
I
fast.
think you hit all
So
the key components.
yeah, I was checking off my list. Okay, got this, hit that. Perfect. All right. So, Yonah, yourself, you're also a real estate investor, right?
Correct.
Why is it important for investors and also operators, syndicators like Ethan and I, to understand cost segregation?
Well, no one wants to pay taxes, right? So,
Right.
I mean, obviously you want to understand it because you want to know if it's going to be applicable to you. Now, it doesn't, just because we describe this incredible way to get these tax deductions, it doesn't necessarily mean that, everyone's equal in getting that. And as a real estate professional, which is an IRS terminology, which says that if you spend more than 50% of your time in the real estate trader business, then you can actually use these depreciation deductions to offset all of your active income as well. Okay. Whereas if you're just a passive investor and you're not a real estate professional, then depreciation deductions and cost segregation, which creates huge depreciation deductions, can only be used to offset the income on your income tax from the investments. Okay. So the passive income from properties, that you can offset that with the depreciation. So you want to know about this because number one, when you're investing passively, then your investment essentially over the first 5 years, if you're doing a cost segregation study, in most cases, the money that you've invested, the returns that you get on that investment over the first 5 years will be, in most cases, tax-free returns, okay? Which means you're making, I don't know, let's say you put in $100,000 into a deal and you're making, it's favorable, $8,000, right? 8% return. Guess what? If you didn't have these depreciation deductions, that $8,000 would be taxed, okay? You're going to be taxed at your ordinary income tax rate, which is probably, 30, 35, 39%, whatever that is. You're only left with, $4,000 or $5,000, okay? But if you have that $8,000 and you have depreciation deductions, that means that's tax-free. You're actually, in many cases, get a loss. It will actually go into the negative, which means all of that $8,000 goes into your pocket, okay? Now, there are very few, if any, type of investment vehicles that I know of that are, income tax-free returns. So I think that's the most important thing to note for the passive investor. And as I said, the active investor, who's the syndicator or who's someone who's involved, they can use those huge deductions if they have more than it is to offset the income from the property. Then they can actually go ahead and use that to offset other income. If that's, any fees that they'd be making, if they're a broker, if their spouse is a W-2 worker and they're making, money from that, those depreciation deductions you can offset that and lower your income tax liability through those deductions.
Man, that's amazing. So you can actually make money, but actually and show a loss. That's like crazy concept to really fathom, right? And that's the beauty that we like about this opportunity or this great experiment that America is. You make money and you count as a loss through the cost segregation.
Yeah,
That's
right.
amazing.
Right. Well, I guess it's based on the idea that, if you bought a brand new roof in 5 years, it's not going to be as new as it was when you first bought it. So
right.
In some sense, it's losing its integrity. It's losing the things that make it valuable. It's older. It's losing its value. So that's depreciation. And even though it may protect just as well as it did in year one, on paper, you're able to count that as a loss. And so that's why this is a very cool concept of looking at everything in there. So this is it's important for investors to understand this because